G'day, Gain Squad. President Donald Trump just issued a stone-cold 2-week deadline for April 27th that could effectively delete the global energy market overnight. If you think your tech stocks are safe, you are dreaming, because the entire generative AI bubble is currently one spark away from a total meltdown. Today, we are uncovering the truth behind Trump's April 27th ultimatum, the massive AI infrastructure copper grab, and why the S&P 500 is having a proper wobbler. Let's see where the smart money is flowing today as we break down the $4,700 gold floor and the hidden war for data center commodities. We are looking at why the Magnificent Seven are splitting up faster than a bad Tinder date, and how the Strait of Hormuz blockade is rewriting the rulebook for gold getters. Just a heads up, traders, I am a tech professional, not a financial advisor, so please do your own due diligence before putting your hard-earned cash on the line. The big question for today is simple. Is gold actually a safe haven when liquidity dries up, or is this the beginning of the biggest bull trap in history? Drop a comment with your price targets, smash that like button, and subscribe to Goldie Gains to make sure your portfolio stays golden while the world goes mad. Trump is back on Truth Social and he is absolutely firing off, setting a new 2-week deadline for April 27th, 2026. He is threatening to take Iran back to the Stone Ages if the Strait of Hormuz isn't reopened to supertankers immediately. Struth. The Islamabad peace talks officially collapsed on April 13th after 21 hours of deadlock negotiations between American and Iranian officials. Trump's latest post claimed that a whole civilization will die tonight if they don't comply, though he says he doesn't actually want that to happen. He has reportedly instructed the Pentagon to prepare for strikes on power plants and bridges if the 2-week ceasefire isn't extended by the new deadline. This geopolitical circus is why gold getters are seeing such wild swings, with the safe haven premium being priced in and out every hour. Trump told reporters at the White House that the US military has the capability to go far longer than the initial 5-week projection. He calls this a long-term problem that is finally nearing a resolution, but the market is clearly not as confident as he is. If that April 27th deadline hits without a deal, we are looking at Power Plant Day and Bridge Day, all wrapped up in one. The Pentagon is currently holding off on hitting energy infrastructure, but the US military is making active preparations for potential strikes. Traders are watching their screens like hawks, because any move toward a maritime blockade would send oil and gold into a different dimension. It is a high-stakes game of chicken that has the entire global financial system feeling like it's walking on thin ice in the middle of summer. Every time a new Truth Social post drops with expletives, the volatility index for energy spikes like a heart rate monitor. We have to optimize this entry, because the window for cheap gold might be closing faster than a pub on a Sunday afternoon. The war in the Middle East is slamming into the AI infrastructure bubble like a runaway freight train, and the impact is massive. Generative AI server clusters are essentially giant copper-eating monsters that require nearly double the wiring of traditional cloud facilities. A single high-density AI data center can demand up to 50,000 metric tons of copper to function properly at full scale. We are seeing a red gold rush because these servers need specialized 800-volt DC power systems and heavy-duty copper busbars. Liquid cooling is now mandatory for the latest NVDIA chips, which means high-purity copper cold plates are in short supply. While aluminum used to be a cheaper option, it just cannot handle the thermal density of the latest generative AI hardware. This technical hard stop has forced big tech companies into a fierce bidding war for every ton of refined copper available on the market. Copper prices hit a historic high of over $14,500 per metric ton earlier this year due to this demand shock. The global supply gap for copper is projected to be as high as 330,000 metric tons by the end of 2026. Smart money knows that without copper, the AI revolution is basically cactus, no matter how good the software is. If the energy crisis from the war continues, the cost to run these massive data centers will go absolutely parabolic for hyperscalers. We are looking at a structural deficit that could define the global commodity markets for the rest of the decade. Fair dinkum. Infrastructure providers are scrambling to secure long-term contracts for metals, even as the war makes shipping routes more dangerous. The military-industrial complex is also competing for these same raw materials, creating a double whammy for supply chains. Every missile fired is a distraction from the commodities needed to build the digital future, and the market is starting to realize it. If you thought AI was just about code, you missed the part where it requires massive amounts of physical, expensive hardware. The energy-driven inflation from the conflict is making the cost of building these server farms much higher than anyone expected. This is a proper golden entry for commodity traders, but it's a total nightmare for tech firms trying to maintain their margins. The S&P 500 closed at 6,886.24 on April 13th, trying to stage a cheeky recovery. It has retraced about 7.6% from its mid-March trough, but it is still flat for the year 2026. The market's having a bit of a wobbler because it hasn't fully unwound the geopolitical risk premium despite the temporary ceasefire. On the home front, the ASX 200 surged back to the 9,000 level on April 14th, led by our legendary mining stocks. BHP and Rio Tinto are carrying the team as global material demand stays thirsty for everything we can pull out of the ground. Lithium and uranium stocks are also going mental, with some names jumping 8% in a single session on the ASX. Wall Street is currently caught in a geopolitical paradox, where bad news for the world is sometimes viewed as relief for the indices. But don't be fooled. The gap between stock prices and economic reality has never been wider than what we are seeing right now. The S&P 500 is facing massive resistance near the 7,000 mark, and it needs a lot of fuel to break through. While the index rallied on ceasefire hopes, the US dollar hasn't dropped much, which is a classic signal of underlying market fear. Smart money is rotating out of defensive sectors and into beaten-down tech, but they are keeping one foot out the door. The ASX 200 intraday high of 9,021 on Tuesday shows that buyers are still active on the dips. We are seeing huge volumes in S&P 500 futures, with some reports of massive insider trades happening just before major news drops. The system feels a bit fraudulent to some, but as traders, we just have to play the cards we are dealt and stay agile. It is a K-shaped recovery, where the rich get richer and the rest of the market just prays for a rate cut that isn't coming. The Magnificent Seven are no longer moving as a pack, and the divergence within the group is getting really spicy for investors. Meta Platforms is looking like a high-conviction buy because they are actually monetizing AI better than almost anyone else in the group. Meta is trading at a relatively cheap 21.3 times forward earnings, making it the value play of the tech giants. NVIDIA and Microsoft are still the kings of the digital gold rush, with their chips powering every single AI project on Earth. But Apple and Tesla are the absolute laggards of 2026, currently stuck in nasty, sustained downtrends on the charts. Apple's top-line growth has been flatter than a pancake since 2023, and they are losing market share in key regions. Tesla is facing even bigger problems, with its industry-leading margins now resembling a legacy car maker rather than a tech disruptor. Tesla's market cap of $1.5 to $5 trillion is hard to justify when its vehicle demand is stalling so hard. Amazon and Alphabet are still crushing it, with Amazon's strategy of being a host for AI models paying off in a big way. Hyperscalers are planning to spend over $200 billion on capital expenditures this year alone to win the AI race. If the Magnificent Seven starts to bleed out, the S&P 500 will follow them down into the abyss, no wuckers. Sovereign wealth funds from the Middle East might start selling their tech holdings to meet budget shortfalls caused by the war. This would put massive downward pressure on the big tech names that have been propping up the entire stock market for years. Smart money is looking for earnings that justify these premium valuations, not just more hype and colourful slides. If NVIDIA hits a ceiling on production due to the copper shortage, the entire AI trade could fall apart very quickly. This is why Meta is standing out. It has high margins and plenty of cash flow without being as dependent on new hardware releases. Tesla needs its robo-taxi or Optimus projects to start printing money soon, or it might just become another car company. For now, the leadership in the tech sector is rotating, and you need to be in the right names to avoid being a bag holder. Don't just buy the dip on every tech stock. Look for the ones that actually have a path to real-world profitability in a high-rate world. The market is being extremely picky right now, and the margin for error for these tech giants has never been thinner. WTI crude oil has been a total rollercoaster, surging 13% to over $112 per barrel in early April. By April 13th, oil settled back toward $96 as the market priced in some hope for the ceasefire talks. The OVX crude oil volatility index is currently screaming at 80.55, which is 3 times higher than January. This level of volatility is a clear warning that the energy market is on a knife edge and could snap at any moment. When the OVX is this high, it usually means that a massive price move is brewing, and it's rarely to the downside for long. The US maritime blockade threat is the single biggest catalyst for oil, as it could cut off 20% of global supply. Gold getters should know that high oil prices are actually a headwind for gold because they force the Fed to stay hawkish. When energy costs spike, central banks are less likely to cut interest rates, which makes non-yielding assets like gold less attractive. We are seeing a split market, where the old-school rules of gold and oil moving together as a pair are being broken. Central banks in energy-dependent nations have actually been selling gold reserves just to pay for these insane fuel costs. If WTI crude breaks back above the $112 level, expect inflation to come back with a vengeance in the next CPI. The gold-to-oil ratio is sitting around 41.5 to 8, showing that oil is starting to catch up to the gold rally. The market is terrified of a stagflation scenario, where growth dies but prices for fuel and food just keep going up. Ray Dalio, the legendary founder of Bridgewater, is out here saying you should have 15% of your portfolio in gold. Dalio thinks the current economic climate is a mirror image of the 1970s, with high debt and zero confidence in paper. He warns that whoever controls the Strait of Hormuz wins the war, and the dollar's fate is literally hanging in the balance. Meanwhile, Warren Buffett's Berkshire Hathaway has been quietly buying into insurance giant Chubb, positioning for a volatile world. Buffett might call gold non-productive, but his massive cash pile tells you everything you need to know about his fear of a crash. Other institutional giants are recommending a mix of innovation stocks and inflation hedges like gold ETFs to survive the shock. Goldman Sachs has named gold-backed ETFs and infrastructure stocks as their top picks for this period of global uncertainty. Legendary investors are disagreeing on the why, but they all seem to be moving towards safety and tangible cash flow assets. Jim Rogers says to buy gold when nobody wants it, but right now, it seems like everyone is trying to get a piece of the action. If you follow the smart money, you'll notice they are diversified across metals, energy, and high-margin tech, not just one sector. Spot gold took a nasty 1.9% dip on Monday morning, April 13th, falling to $4,658. This was a direct reaction to the collapse of the US-Iran talks in Islamabad, catching a lot of over-leveraged traders off guard. But gold proved its resilience by staging a classic V-shaped reversal from an intraday low of $4,631. By April 15th, gold was sniffing around the $4,836 level in pre-market trading, looking for a breakout. This is a proper golden entry for those who bought the dip near the 4,650 support zone, where central banks are parked. Central bank demand is a structural pillar for gold, with purchases expected to hit 900 tons for the full year of 2026. Emerging markets like China are adding dozens of tons to their reserves every month, creating a hard floor for the price of bullion. We are in a geopolitical paradox, where gold is acting as a source of cash for institutional investors, facing margin calls elsewhere. While 50% of Wall Street analysts are short-term bearish, 63% of retail investors are screaming for a price rise. The current trading range is established between $4,600 and $4,800, but it's looking very tight. The US dollar index, the DXY, is hovering near 98.40, keeping a lid on any immediate parabolic move for gold. If the DXY stays strong, gold has to fight twice as hard to reach that psychological $5,000 milestone this year. Inflation is currently the bigger threat in the eyes of the market, even more than the actual missiles being fired in the Gulf. Traders who can navigate this volatility are treating it as an opportunity, while the cattle are just panic selling the red candles. Keep an eye on the US Producer Price Index data, as it will be the core catalyst for the next 48 hours of trading. If the data is hotter than expected, gold might retest the $4,700 level, so stay sharp and watch your stops. To wrap up the week, Trump's April 27th deadline is the ticking time bomb that everyone is watching with bated breath. The Islamabad talks failed, the Hormuz blockade is back on the table, and gold is bouncing back from $4,631. AI infrastructure is creating a massive copper deficit that is pushing commodity prices to levels we haven't seen in decades. The S&P 500 is struggling with a geopolitical premium, while the ASX 200 is riding the mining boom to 9,000. Meta and NVIDIA are the tech winners, but Tesla and Apple are dragging the chain like an old anchor in a storm. Technicals show gold at 4,836 with a daily RSI of 71, suggesting things are getting a bit overbought. The 50-day moving average at 4,755 is the line in the sand that bulls must defend to keep the dream alive. What do you reckon, Gain Squad? Are we heading for $5,000 gold before Trump's deadline, or is the dollar too strong? Let me know in the comments if you are backing the AI copper boom, or if you are parking your cash in physical gold for safety. Smash that like button and subscribe if you want to stay golden and keep your portfolio from having a massive wobbler this week. Keep your positions tight and gains golden I'll see you at the next close. Cheers!